I'm Bill Mayer, past chairman of the Institute. I know a lot of people in the audience. A number of you, I think, should be up here talking about this rather than me, but we'll get to that in the Q&A session. To my right is Keith Banks, who I've known for quite a number of years. Keith is the Chief Executive Officer of U.S. Trust. Been a client of theirs for over 30 years. And he is also, U.S. Trust is kind enough to have been a sponsor for a number of years, and again this year. So Keith, thank you for that and helping make the Ideas Festival possible. Keith and I did this, have done this, I think this is our third year.
Yep.
And so we were talking before about what should we talk about and what would you like to hear about from us and the thoughts from the purview that Keith has from all of the clients around the world. So we're going to do that as a kind of a Q&A between us and then try to leave some room at the end for the thoughts of all of you out there. So Keith, again, good morning and welcome.
Good to be here.
So what's new with you and U.S. Trust and your view of your clients worldwide in the past year since we were here last? Because in some sense it seems a lot has changed, but the mood is pretty similar.
Yeah, it's interesting, Bill. It's almost an identical situation, right? So we started this year with a lot of high hope that we were going to, kind of emerge from the economic morass that we've been in the midst of, and we'd start to see better growth and higher profits, and then have the markets reflect all the above. And we started off that way, right? And part of it, I think, is just the optimism of a new year. And so we had a lot of liquidity come into the markets. Some of the issues in Europe seemed to fade, although they really hadn't, as we found out. And it looked like growth in the U.S. was, in fact, beginning to tick up, right? We saw some higher growth rates. Unemployment rates, although still too high, were coming down somewhat. And people felt good, and we had a very, very significant rally in the markets. And just like last year, the bell rang right around the same time. We found out that, oh, by the way, Europe was not fixed. The problems were just kind of laying dormant, and then all the issues in Europe began to rise up again, and the worries around that. And then we began to see in the U.S. Our growth decelerate, not to the point of a recession, but certainly slower growth than people had hoped to see. And now we're seeing again, as far as growth in employment, that's beginning to slow down and maybe even back up. And so, as we talk to our clients, I think the worries, the concerns, the dialogue, at least around the economy and the markets, seems eerily similar to the dialogue we had last year and even the year before.
So the economic growth slowed down a little bit, but the companies that I'm part of or on the board of are actually doing okay with economic growth, call it 2, maybe a little more, a little less %. Is that what you're hearing from your clients? Fair amount of cash around?
Yeah, there's an interesting dichotomy. So when you look at the economy, we had thought this year maybe we'd see 2 to 2.5% real growth in the U.S., and now we're probably looking for 1.5 to 2. I think what's going to happen between now, between now and the end of the year, Bill, is a lot of stagnation. I think companies are going to be on hold between now and the end of the year for 2 reasons. We obviously have a very important election coming up in November in the U.S., and then we have this thing they call the fiscal cliff at the end of this year, and that is, unless some action is taken, we're going to see a significant increase in taxes and a significant cut in spending. And some of the estimates are, if that flows through unabated, that could take 300 to 400 basis points of growth off of the economy. So if you do some simple math, if we're growing at 2 and we lose 300 basis points, that's called a recession. But when we talk to our clients, and a lot of our clients are business owners, and the kind of business owners that the country is looking to add the jobs. They're the kind of the job creators. The interesting thing is when I talk to our clients and I ask them about their business, they tell me, A, they have record levels of cash, B, they have record levels of cash flow. So I ask the obvious question, which is, are you hiring people given that? The answer is no. Are you putting capital to work given that? The answer is no. And a lot of it comes down to the continued uncertainty in the environment, not knowing what the rules of the game are still, and the rules of the game they know aren't very positive rules. And their reaction is we're very contentious to kind of sit where we are, watch the world turn a couple times, and then see what we've got, in the next 3-6 months.
So when you're talking to your clients, not only your business clients, but the high net worth individuals that people really deal with all of the time, what do they want to talk about?
It's really interesting. We obviously talk about, the managing of their money. The typical client that is a client of U.S. Trust is, someone that we're helping manage their assets. And for U.S. Trust to be a client, you need to have at least $3 million of investable assets, and it goes up from there. But what's interesting, Bill, is that we're seeing the dialogue changing, and the focus of the client is changing. So their investment portfolio is still important, but they're worried about a lot of other things that arguably are much more important, like things such as intergenerational wealth transfer. There's going to be a lot of money that's going to pass over the next however many years, and our typical client right now does not believe their children are prepared to receive that wealth and be good stewards of that wealth. So they're very concerned about what is it they need to do. They want to make sure, number one, they've got the right type of estate planning in place. Number two, they want to make sure that they're doing what they should be doing to prepare their children to inherit that wealth. Because A, as I said, they want the wealth to enhance their lives, not destroy their lives. We've seen both movies play, unfortunately. Our typical client is very philanthropic, and they want to see, they believe very strongly that when you have wealth, there's a responsibility to give back in some fashion or form. They want their children to have those values and that mindset. And philanthropy is a big part of that. So they look to us to really, and we've developed a program to work directly with the children. But the other thing which is interesting, and it concerns me that more broadly the right dialogue is not taking place. We did a survey recently of non-U.S. Trust clients, because we know what our U.S. Trust clients are thinking and doing, because we talk to them every day, literally. But we wanted to get a broader sense of people of wealth, not with us. And one of the things that's interesting is 88% of the respondents said the most important thing to them, single highest priority, was that they did not become a burden, either financially, emotionally, or physically, on their children. 88%. Yet only 50% of those same respondents are taking steps right now in their own long-term planning to ensure that that's not the outcome. The other thing that was interesting is when you look at, and there was an intergenerational, we talked to the Gen X and Yers, the boomers, and the pre-boomers. So you had a good range of folks, and they had at least $3 million of assets. The other thing they said, consistent with that, is that already when you look at the Xers and Yers and the boomers, 50% roughly of those individuals are already beginning to spend money to help ailing parents or relatives. And yet when you then say, so are you planning for more of that, only 17% of the respondents are in fact in the midst of a long-term planning session to take into account that number will most likely get bigger and bigger as time goes on. So what I'm worried about, I think this has implications for our individuals thinking about themselves the right way. The other question is, are their advisors having the right dialogue with them? So number one, we need to make sure that people are thinking more broadly than just, how is my investment portfolio doing? And number two, the advisor they're dealing with is initiating that dialogue if it's not kind of front and center already with the client.
So this session is partly about investing or not investing in uncertain times. So we start from the very top. We talk about the U.S., and if we go even higher and we talk about the world, what you and I were talking before is what's going to drive global growth. We have China, which seems to be slowing down, but you felt that at least from the view of Bank of America and U.S. Trust, that no, they don't hit the wall. Europe is economically probably in a recession.
Yes.
Probably going to stay there for a while. We have tremendous tension, of course, between Germany and basically the rest of Europe. And that's something that is, I think, almost cultural. I mean, I remember 50 years ago my father saying, who was European, he said, never forget that the Germans are still fighting the inflation of the 20s. And never forget, in the United States, we're still fighting the depression of the 30s. So when push comes to shove, the Germans will be screaming and dragged to the altar of trying to stimulate fiscally. And the United States, of course, we throw everything at the problem. Not that one is necessarily right or wrong, but cultural. And my God, you're seeing that play out not right now. And so there's a high-stake game of poker going on in Europe, and it has to have, as it has here, a tremendous drag on economic growth because of the uncertainty, right?
Yeah, we look at the world kind of in three chunks right now, Bill, to your point. So we got the U.S., and as I said, we're looking this year for 1.5% to 2% real growth. So not great, but again, it's enough growth to sustain profitability, and you know, jobs may not grow fast enough, but there should be ultimately some additional job growth. Probably not until till next year. You got Europe that we think right now is in a recession to the tune of -1% to 2% negative growth. And that assumes that the ECB and the EU starts to really put in place the programs they need to put in place and do what they need to do, a la the Fed, to your point, around liquidity and rates to really get themselves, because the problem is Germany is still fighting the inflation war, and the war they need to be battling right now is the deflation war, which comes about when you have excess debt.
Sure.
So you got the US, you have Europe, and the bad news we think for Europe is even if they get their act together, they've been so slow in responding and are still not quite responding where they need to be in our minds, that they're going to be mired, we think, in subpar growth, even if they emerge from the recession for a number of years, you know, similar to what Japan has gone through. Then finally, the good news part of the world continues to be the emerging economies. So we think, you made the point, that China manages to slow down, does not crash and burn. They still grow by 7.5%. I mean, just think about that number. That's the slowdown growth. And then it begins to pick up from there again. And then you got other countries like Brazil and the rest of the emerging economies in Asia, Latin America, growing between, you know, call it 3% to 6%. So global growth, if you kind of mush all that together and look at a global growth rate, you know, we think global growth is about 3%, and we would expect to see that accelerate as we get into 2013 and beyond.
So when we were thinking about it, it's pretty hard. You know, everybody in the room here tries to be realistic. We all try to do that. Some of us, by personality, are a little more glass half full. Some are a little more glass half empty. And the United States, over the past few years, has been pretty easy to be glass half empty, right? And I think that part of the problem we've had, as you described, the lack of confidence of what the rules of the road are. And so therefore you don't have much capital spending, you don't have much hiring until that becomes clear.
Right.
So let's talk the other way and talk about, just for a few minutes, about the glass half full, and what would be some of the upside scenarios and the components of that in the United States going forward.
Yeah, look, I think it's a great point, because we all like to kind of get wound up on all the stuff that can go wrong. And just as we're focused on that, a few things go right, and also the market wasn't anticipating that, and we're all surprised to see the market up 15, 20%, right? So I think there's a number of things in my mind, Bill, that could do that. Number one, don't lose sight of the fact that even with the slowdown in the US, the recession in Europe, the slowdown in the emerging economies, in the United States, profits are still very good. The typical company is seeing very good profits, in some cases, in many cases, record levels. And as part of that, they're seeing, as we talked about a minute ago, record levels of cash and cash flow. So that's happening today. But what can go right incrementally that would even drive it further? I would offer up, number one, the housing industry. Now, we're seeing some little glimmers of stabilization in terms of home sales, in terms of even pricing in some regions. But think about if we got the construction industry, because the whole residential side of the equation gets back to a more normal level. Numbers I see say that right now the inventory of single-family new homes is at an all-time low. I mean, as long as we've tracked it, this is the lowest level ever, which means, and yet we've got housing has never been more affordable because home prices have come down, not necessarily a good thing, but a reality. Obviously, rates are at record low levels. And as you start to get some better job creation, people are going to still want to own homes. They're not going to speculate the way they did, we hope, but they're going to want to get in there for their families and buy a home and own a home. When that starts to happen, the residential construction industry is going to be caught flat-footed, and they're going to need to scramble and start to get this inventory built. And think of the ripple effect. So just think about that dynamic, jobs created through the construction industry, but then the number of industries that will piggyback off that and benefit from that will be enormous. So that's number one, I think that can go right. And I think we're getting closer to that point than not. The second thing is the auto industry, right? If you look at just getting back to levels that are production that are more consistent with just replacement demand in automobiles. The one thing we do know is cars get older and eventually don't work, and you need to get new cars. And we're well below that replacement demand level of production. As that begins to happen more and more, again, there's an enormous ripple effect because of all the industries that feed off the auto industry, and that can be a positive. Then the third thing, and we touched on it before too, right? We do have companies with record levels of cash and cash flow, and they're not hiring. That will change at some point, but they're also not putting into the capital base. And if you look at the aggregate levels of capital spending relative to depreciation, companies are way below where they need to be to sustain the plant and equipment they've got. And again, like cars, at some point, things just stop working. So those are three major things, Bill, that I don't think people are focused on. They're looking at the negative aspect of it, but not the glasses half full aspect of it. And those three things, especially if they happen relatively close, that could be a big driver of economic growth here in the U.S. and globally.
So we have the gridlock in Washington, or whatever word you would like to use. And of course, it's created the uncertainty as to the rules of the road. And all of us that are in business, at least I tend to say, look, fine, just tell me what the rules are, and then I can make the appropriate decisions of how I can make investment decisions and if I can get an adequate return. So something is going to happen by the end of the year, we hope. Mm-hmm. And so this issue of confidence is something that I think relates to, this is now, depending on when you start the clock of this current economic uncertainty. Is it 2007? Is it 2008, when the world really got turned upside down in September with Lehman? Right. I think we now look and say, okay, 2007. So we're basically 5 years into this. And I don't think just about everybody in this room, we haven't been through this before. We haven't been through a 5-year period. And it's pretty frightening on the psychic of people that are trying to make decisions. And yet, on the other hand, even with just a 2% economic growth, the companies I'm involved in, we actually can do okay.
Right.
You know, you've resized, you haven't grown. The question, I think, is, in terms of the longer term, the economic and social question is unemployment, because I really am having a very difficult time understanding how that will go down.
Right.
And that impacts a lot of things.
Well, look, I think we're still in the midst, unfortunately, of absorbing the decisions that companies are making, need to make, just for the realities of what's gone on, right? Right. If you look at a lot of companies, the regulatory changes, and whether they were good or bad changes, put that aside, right? The reality is it's created a significant burden on companies, large and small. It costs, I saw something the other day where, I think it was Jamie Dimon was being interviewed, and I think he said the number for JP Morgan was that they're spending an incremental $1 billion just to meet the regulatory requirements that are now part of the financial services industry, which obviously we're part of as well. Just to give you the magnitude of what companies are dealing with, right? So if you need $1 billion incremental to do that, you're going to take it from somewhere else. Otherwise, your profit's down by $1 billion, and that's not going to happen, right? So I think the bad news is there's what they call a J-curve effect going on. I think we need to go lower before we can go higher, because we still have the lagged effect of what companies are doing, need to do to respond to the loss of revenue or the increased cost associated with the regulatory realities of the new world. I think once that happens, though, Bill, and it'll take a little more time, and I think it's going to kind of play out through the rest of this year at least, then I think, to your point, because I think companies and management want to get going again. So if we can create more certainty around the rules of the road, a better idea of what it's going to look like going forward from a regulatory, from a taxation standpoint, and create hopefully a more positive environment, I think if these companies hear that bell ringing, I think there's so much pent-up ability to go out and hire and put capital to work. Again, given that cash flow, I think you could see a very rapid uptick in our economic growth rate in the U.S. if we can get the business community in aggregate more confident and ready to get back to business. And my conversations with the executives who are clients of ours, they're ready. They want to. They don't feel they can right now because they're just taking a risk they can't take on behalf of their shareholders or whoever the owners are of that business.
Yeah. There's one other item, and while it's anecdotal, one of the companies we own part of has a plant in the middle of Pennsylvania. And about 7 years ago, we outsourced the production of a part of their product to China, like a lot of other people did. And the decision was made last month to bring the production back to the United States. Now, it's only 40 jobs, who cares? But it was very interesting when you went through the logic path of making the decision, is that the Chinese currency has appreciated by 1/3 in the last 7 years.
Yeah.
Okay? Labor wages in China have gone up. We still have some quality issues. You're tying up capital 6 weeks while it's trying to get here. And when you add it up in today's world, it was frankly a ho-hum. And so it's been, now I think that if that's the experience of this company, at some point it has to be the experience of some other companies.
Yeah.
And I don't know how much that moves the needle in this country in terms of economic growth, but it has to be another variable that could help.
Yeah, look, I think that could be another one of those positive surprises people aren't focused on, because we are hearing and seeing that in a lot of cases for the reasons you mentioned. But people have declared manufacturing is dead in the U.S. Well, first of all, that was just wrong, right? If you go back and look, there are still a lot of manufacturing jobs in this country. Our chief strategist, Joe Quinlan, has written a lot about the fact that jobs are moving back to the U.S. They're not leaving the U.S. in manufacturing. And manufacturing, actually, the manufacturing component of the U.S. economy has been one of the bright spots. And again, no one focuses on it because why would you want to look at something positive? But I think more and more we're going to show we never went away. It got downsized, but to your point, I mean, they're coming back home, and that's a great thing, and that means more jobs ultimately in the U.S. as well.
So here we are now. So where do you put your money? Fixed income. Unless you take inordinate risk, maybe it's not inordinate, it's very hard to get a yield.
Right.
So traditionally, in uncertain times, put it in treasuries. Well, real yield is negative.
Right.
Okay? Stock market, you would think that people are being driven to the stock market because of dividend yields are higher than most bond yields. Mm-hmm. Right?
Yep.
And yet the stock market, by most measures, is not certainly expensive. Yeah. And by some measures looks reasonable. Mm-hmm. So where do we all go?
Well, the first thing I say, Bill, and we talk about this a lot, I think the mistake a lot of people make is they look at the wrong time frame. They're trying to figure out the next 3 months, 6 months, or even the next year, and they get wound up on what I refer to as the data point du jour, right? Every day, the media blesses us with another economic data point that's either good or bad. The market rallies or goes down, and not insignificantly, 100, 200 points on the Dow. And like that matters, right? And it's noise. It's noise in the system, but we're fixated on it, right? We try to zig and zag. So number one, you got to broaden your horizon, your investment horizon, and think the next 2-3 years, which we would consider kind of the intermediate term. When we look out over the next 2 to 3 years, we're actually positive on the equity markets. The fear and greed thing is a powerful driver, and right now the fear factor is driving emotion and driving decision-making, and a lot of people are conservative and just feel it's too risky to be back, in the stock market, but yet they'd be willing, to your point, to go buy a treasury bond, for yielding 1.6%-ish, and basically losing money in real terms. And if that rate backs up, you'll actually lose money because the price will go down as the yield backs up.
Right.
So we're saying, number one, around 1,300 on the S&P, which is what we focus on. We think that's a good time to be building back positions in equity. Again, taking that longer-term horizon. We have a theme that we call getting paid to wait. And what that means is, you get a return 2 ways. Number one, through the appreciation of the asset. Stock prices go up or bond prices go up, or commodity, whatever it is you're doing. Or you get paid a yield, through the dividends in common stock or the coupon on a bond. So number one, we're saying whether it's equities or fixed income, get paid to wait. Because we think we're going to see a lot of kind of gyrations, but pretty much no real trend upwards for a period of time here until things sort out. But if you're getting a good dividend and a growing dividend from these big multinational companies, and by the way, these companies benefit from that 3% global growth rate because they're exposed globally, that's a good thing, and you're getting paid in corporate bonds or high yield bonds, or even in some cases, we like munis too in selected areas, then you're getting some return today, then ultimately when the fundamentals start to kick in and get more fully discounted, you'll get the appreciation component as well. So we would say begin the process of slowly building up positions again in equities. If you're in fixed income, and again, we believe in an asset allocation context, you never want to have all your eggs in any one basket. I don't care how good that basket looks. So you want to own fixed income, you want to own equities, you want to have international as well as domestic. Cash could be part of it. It all depends on your risk tolerance and what return objective that you have. So we are beginning the process with clients of moving money back into equities.
Equities, and you are more encouraging U.S. equities, or a lot of people still emerging markets?
Yeah, we like U.S. equities, and we like, again, the large cap multinationals that are dividend payers and dividend growers. So they're using that cash flow. Maybe they're not hiring people, maybe they're not putting it in capital, but they're returning that money back to the shareholder through higher dividends and stock buybacks. So we like the U.S., mainly the multinational, the big large cap stocks. We like emerging markets because that's where the growth is. And we think that a lot of those stocks, a lot of those markets have pulled back because of the concern of a deceleration in growth. We are underweight the other developed markets internationally. We don't like Europe for the obvious reasons we just talked about. They're in a recession, it could get deeper, but a lot of uncertainty, and we still don't like Japan. So, and we think the U.S. will do much better than those other developed countries, but a mix of U.S. and global makes sense and focused on emerging.
So the U.S. has been described by some people, some friends of mine, as in a closet of dirty shirt with the least dirty shirt. Right. And so that's probably one of the reasons why capital still comes to this country, because when you're looking around the world and where you're going to go, there are really not a lot of places. And a few years ago, people thought, okay, the euro will become a form of reserve currency. Right. And that day, I think that day has passed for quite a while. And so as we go forward here, I think that, speaking personally, you tend to stay in a place that you're more familiar with, because we talk about a lack of confidence or a lack of certainty just overall, and I think that we all tend to sort of draw back a little bit and try to get into more comfort zones. So I think psychologically it's a little more difficult to go overseas, although that's probably where your longer term returns are.
Yeah, I'd say a couple of things. It's kind of like going to a doctor, right? I mean, you like to go to your local doctor because you know them, they're blocks away, but the specialist may be in the big city, and so get to the big city, right? Same thing investing. You can't go where you're comfortable. You got to go where the opportunity is. You got to go where the value is. And what I would encourage people to do is, this is one of these don't try it at home things. You see these silly tricks and people jumping off buildings and stuff. Well, this is the equivalent of jumping off buildings. I mean, people trying to trade on tips they get or friends who know something, and they go out and watch CNBC, and with all due respect to CNBC, but then try to make decisions on their own. You're up against professionals like U.S. Trust and many, many other firms that literally all day, every day do nothing but this stuff, right? We have experts, we've got lots of them. They spend 24/7 just thinking about investing and trying to come up with the right ideas. So this is not something I think we've all learned. If you try it at home, you can really hurt yourself. Find a good advisor, find an advisor you can trust, find an advisor that can talk to you about not just the investment, but that can have the broader dialogue with you. Because it's more than just, are you earning an extra 50 or 100 basis points on your investment portfolio? Are you doing probably the more important things? Are you planning for aging parents? Are you planning for your children, when they inherit the wealth? Are you doing the other things that you need to be doing? Find someone that can help you with that, and then trust that firm. And again, the horror stories of people trying to go it alone are just, I can go on for hours. But
okay, good. I think what we might do is try to open it up to all of you, and see the kind of questions you have. And and when you come to the Aspen Institute, there's always a comma, however. And so wait for the mic to get to you, identify just who you are, and then please ask a question and don't make a speech. Thank you.
Yes, sir.
My name is Ron Sims. My question is, what was the overall effect of the Boeing issues on your clients in their thinking, in terms of their desire to open the new plant, et cetera?
Regulate, yeah.
So help me understand specifically what aspect of the Boeing are you?
You're talking about, you know, they want to go to South Carolina. Federal government basically said, not so fast.
Then they eventually opened the plant.
Well, you know
In
that.
fact, when I was visiting, we have colleagues down in South Carolina. It's not too far outside of the airport, and they showed me this beautiful plant that employed, I can't tell you how many people. Look, I think what's going to happen is there's a little bit of a zero-sum game going on in the U.S., you know, kind of to that example, you know, where you get a plant shifting from point A to point B. So wherever, you know, if it was in L.A. originally and now it's in South Carolina, there's going to be loss here and then gain there. I think we got to allow companies to run their companies, build their plants where they believe they can be most competitive. Boeing's in a global business, a global industry, and they've got to do what they need to do to compete globally. It's not just a matter of what's good in the U.S. You know, so there's no real impact on our clients per se, but I think it's just the natural course of events that are going to take place. And look, in some cases, companies are even moving offshore. I told Bill an example of a firm that I'm familiar with that decided to build a new plant in Australia simply because they had an operation there already, simply because of the tax regime here in the U.S. They calculated over 5 years they would save $1 billion in tax payments by having this new plant in Australia. So, but on the other hand, we've got a lot of companies coming back to the U.S. So there's a lot of moving parts in the equation. And again, I think we got to look at the bigger picture. If companies are making good decisions that are driving their profits, that will and their cash flow, it'll ultimately drive employment, it'll ultimately drive capital spending, it'll ultimately drive the kinds of things we need to see to get the economy growing at a faster pace, get job growth growing at a faster pace, and getting this country back to the levels of growth and prosperity that we're used to seeing and should be seeing, given how great this country is.
A quick example. I think that some people in this country do not understand that there really is competition between the states to attract businesses, and what you just pointed out is a classic example. I went through one last year making a decision about, I'll name names, being in Connecticut or Virginia, and after about a week of talking to people, it was a no-brainer. You know, I went to Virginia because they were business friendly, they're willing to help. And in Connecticut, they couldn't get past the idea that giving up $1 today for the potential $3, $4 job growth and so on, they just couldn't get there. And I look at the competition, and of course it exists, and this is what happened. Mm-hmm. And so the regulation, you know, does have an impact on economic growth, and especially regionally and within states. But anyhow, okay, who else? Sure. Well, or we'll get you you'll be next.
Okay. My name is Arthur Greenberg from Los Angeles, and my question is this. What happens if the worst case scenario in the European economy does take place? What happens to us in this country, and how likely is the worst case scenario to occur?
Great question. If Europe really tips over, if -1% to 2% growth becomes -3%, 4%, or 5% growth, deep recession, it'll impact global growth, right? Because I think a lot of the emerging economies, I believe China exports about 20% of their product to Europe. We obviously do a lot of trading back and forth with Europe. So I'd say if that were to happen, the global growth rate of that 3.5% I mentioned before would be lower than that by a meaningful amount. Maybe 3 to 3.5 becomes, 2 to 3, 2.5 to 3. I think the psychic impact of Europe rolling over, the psychological impact on investors and people in general will be meaningful because once it starts to roll, you don't know when it stops and how bad is bad. And I think that will freeze a lot of, I think back to businesses making decisions and hiring and deploying capital, even in the U.S., I think that would probably impact their decisioning around that and probably delay it. And I think that would clearly have a negative impact on global equity markets, global financial markets as a result of that. So I think that's a pretty unattractive scenario and would have clear ramifications, at least over the next, call it 6-9 months. We do not believe we're going to get to that point. I think what they're working on right now, you've got countries like Germany that are focused on austerity, 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 and seem unwilling to compromise because there's a logic, right? They want to see the other countries do what they need to do to ultimately get their fiscal houses in order. I think ultimately as the EU stares down into the abyss, I think they'll coalesce around a point of view. I think it'll be a compromise between growth, how do they get growth going again, and austerity. So they'll try to do the both simultaneously. I think the ECB will begin to flood the market with liquidity. I think they'll take rates lower, a lot of what the Fed did, and I think they will sidestep the disaster scenario. But they got to get going on it, right? They're kind of at that point now. But I think our view right now is that they will not totally roll over. They will make the decisions they need to make, and they will avoid disaster. However, if they do that, we still think this year they're going to be in a recession, and then if they take the right steps, it probably means in 2013 they can begin to slowly emerge back into modest positive growth rates. But Bill, I don't know if you have a good view as well.
Just to add on, when you look at what would happen and why would it happen, and we all know that Germany has the biggest vote. If you think about, okay, tomorrow there's no more euro, so what happens? Well, the German currency, the Deutschmark, will go up by, you pick your number, 30, 40%. Right. And that'll wreak havoc on their exports. I mean, it's really going to cause a problem for the German economy. And they understand that. So this high-stakes game of poker that's going on, what you hope is that, of course, they are reasonable and realistic, as you say, as they're looking down at the abyss. Now, if there is no more euro, it'll take a while because it's the same old story when an equilibrium gets broken, okay? What you hope for is that everything muddles along, which is what we've been doing in this country, long enough to establish new normals and new equilibriums. So if that were to happen, we'll have some form of chaos for a while, there's no question, and it's certainly going to have a drag on economic growth. And ultimately, you probably have something what would look like 15, 20 years ago, where most of the northern companies are doing fine, and most of the southern countries are having chronic inflation. But if that happens, there'll be a lot of news to report.
Yeah, Germany's got a lot of leverage right now because they're kind of the deciding vote, and I think they're trying to take maximum advantage of that leverage to get some things done that they know once.
And if we were running Germany, we'd do the same thing.
Exactly right.
Okay, I think you were.
We had a question. There you go.
Actually, that gentleman asked my question. But I had a small question. You said something very interesting to anybody who has high net worth. What programs are you doing for our children?
A U.S. Trust?
Yes, that's, because I don't hear that anyplace else.
Yeah, what we've done, this comes from talking to our clients. So we had started a program a number of years ago. We call it financial empowerment. And it's geared toward children who are 20 to 30-ish years old. And then we really have ramped up this program because we have something at U.S. Trust we call client advisory councils. We have about 100 clients that work with us on 5 different councils. The whole thing is around advice and counsel, right? So we want to keep raising our game. What better way to do it than ask your clients, what else do they need? What can we do differently? What can we do better? And we get great feedback on that. And what came across loud and clear, that at least among our client base, represented through these client advisory councils, the number one issue was intergenerational wealth transfer. And the typical client did not believe their children were even remotely ready to receive the wealth. And they believed, and I have 4 kids, so I get it, right? You can't have the conversation with your own children. You can't even get them around the table, let alone have a dialogue like that. So we really kind of developed a program. It's a 6-module program. In fact, Chris Heilman, who's sitting right over here, who runs our big fiduciary business, Chris was really one of the key architects on behalf of U.S. Trust. But we sit down with clients. We cover 6 modules. It's like all aspects of just kind of life, you know, and we talk about running a business, we talk about getting married, talk about prenups, we talk about all kinds of things, and really begin the process of educating the children, get the ball rolling. At some point, sometimes the parents join us, other times it's just literally us sitting down with the children themselves. And at U.S. Trust, it's not something we do and then say, okay, now you owe me $1.10 for the, you know, it's just part of being part of the U.S. Trust family. It's a capability we bring because we know it's important. And we have a flip side on the elder care. We do a lot around elder care with our clients too, helping them prepare. I told you those scary statistics, and these were non-U.S. Trust clients. You know, only 50% are thinking about and planning for their own long-term care needs, right? The costs that may impact themselves, back to not being a burden on their children. And then we have the, you know, the issue of you know, knowing you're going to be probably spending money to help your parents or other aging relatives. So we have a whole elder care program to try to help prepare clients for that unfortunate inevitability. And, you know, Chris is around if you want to chat with Chris afterwards. He'd be happy to give you more detail. Yes, sir.
I'm Marn Obernar from New York City. We talk about all of these uncertainties, everything from taxes to the overriding problem of the unsustainable national debt, which we really haven't mentioned this morning.
Yes.
In the face of all of that, it seems to me that the business community I've never seen the business community more silent in the face of government inaction. Why do you think that is, that the business community writ large has not demanded the kind of action that we need to sustain growth?
You know,
It's an
it's
interesting
interesting, and there's a couple answers to the question. Number one, you know, you've got to understand that when it depends on, I think there's a lot more going on behind the scenes than you think. Number one, so there's 2 ways you can voice concern. You know, concern's interesting. Solutions are even more interesting. And I know, you know, our chief executive Brian Moynihan has spent a lot of time in Washington. You know, whether it's the business roundtable or whether it's actually sitting down, you know, in a group of 8 or 10 with other CEOs and the president to exchange ideas on how do you get the economy growing faster, how do you get job growth to accelerate, all the things that we believe we have some insight into, because we're saying, it's kind of like our clients telling us, right, here's what we need. We're kind of telling the administration, these are the things that would get us to do what you're looking for us to do, and these are things that make it more difficult for us to do things that you're looking for us to do. So I think that's the behind-the-scenes stuff you're not going to maybe hear about. The more vocal, get in the media, that's a dangerous thing, to be honest with you. When you get out there as a big company, especially if you're in a regulated industry, and you're very vocal, especially if the view is perceived to be a negative view and a critical view, it's not well received. So you got to be careful in all reality. So I think the path a lot of people are taking is the behind the scenes. Let's sit down face to face. You know, whether it's the legislators, it's the president, it's the Treasury Secretary, whomever it is, and try to share ideas and get a partnership going and action being taken. I think there's been some frustration. It's clearly not translating yet the way we hoped it might, but know that, you know, business is trying, but probably in a different way than you might expect, in a less visible way.
The only thing I would add is your last point. I mean, you know, I think there's absolutely no upside for in this kind of environment we have, and I'm not just talking about the government, but the media. There's just almost no upside in trying to do that publicly.
Other questions?
I'm just bursting with this question. My name is Richard Furman. At one point, the Swiss franc was a safe haven. At one point, U.S. Treasuries. At one point, people thought the dollar and gold. What is your one safe haven now?
It used to also be Aspen, Colorado real estate. It used to be. Okay. Well, you're still okay. You're okay.
Look, it's a great question. You know, we don't really think in terms of safe havens, right? Because I think the problem with safe havens, there's the perception is that something is a safe haven. We can all give many examples of what at the time were, and then the reality is they really weren't. You know, a lot of people think treasuries are safe havens right now, right? Even though they're yielding 1.6%. But what if I will tell you right now, if people become more confident in the economy, you know, and just the environment in general, you could see those yields go from 1.6 to 2.6 to 3 pretty quickly. And when yields go up, that means prices are going down, which means you're losing a lot of money. So the way we think about it is not in terms of safe havens, that this is the place you can, I mean, look, cash is always a safe haven, right? You earn no return on it, but you know it's there. So if you want to think of it that way, I guess you can say at some level cash. But that's why, back to what I said earlier, we don't think of a particular asset class or a particular safe haven or a particular vehicle. We think of a broad-based strategy that incorporates a number of asset classes, and the exposure to those asset classes will be determined by the risk tolerance of the individuals. There's no better way to do it. You just can't rely on any one area, whether it's a currency, whether it's a commodity, whether it's an asset class, because there's no such thing. It may be a safe haven at a point in time, but as I said, if you're really thinking over the next 1, 3, 5 years, you know, it's just not the way you play the game. So I wish I had a better answer for you, but I think a safe haven is more of a mirage than a reality, and that's how people lose lots of money.
I couldn't agree more, and actually, if there was such a thing, we'd all go there, and the cost of it would be pretty expensive. And I think that's why you see a variation of that in the U.S. Treasury market, because relative to every other place you may go, it is considered a haven, and as a result, you've got a 10-year Treasury yielding 1.6%.
And what I worry about
because
is
everybody's there.
And what I worry about is people who are in treasuries, I'll bet you a number of them don't understand they can actually lose money in U.S. treasuries and will lose money, you know, when rates get back to a more normal level, which will happen.
Okay, we have, I think, time for maybe one more question. The light is a little bit,
There's one right
here.
here.
Okay, and if we have time, we'll.
In your comments this morning, you did not address the Middle East with respect to the future. So would you shed some color on that?
Yeah, look, the Middle East is a scary place right now. Obviously, there's a lot of moving parts. We just had a change in Egypt, right? You have the Muslim Brotherhood now, is theoretically or in reality running the country. There's a lot of views of what that will mean and won't mean. We'll find out. But no, look, it's unfortunately we're in a world now where geopolitical risk is a fact of life and it's never going to go away, right? The question is how much more challenging does it get? And I think the hot spot right now, is the Middle East. We got all the issues in Iran. We got obviously a lot of changing regimes. All that creates uncertainty. Allies of the U.S. may no longer be allies of the U.S. You have, every once in a while, North Korea gets silly on us and shoots things in the air that blow up, and there's just a lot to worry about. So, I don't have any searing insight or answer. We watch it closely. We're focused on it. When we put together investment strategies for our clients, we take that into account. Because look, we could wake up tomorrow and have something very significant happen that could have a major impact on the markets. The way we think about, and I think about geopolitical risk, I think you need to be cognizant of it. I think it needs to get factored into the, as you think about the risk tolerance you have, both financial and emotional risk tolerance. But I think you need to be cognizant of it, but not paralyzed by it. Because we think, between now and somewhere out there when something significant could happen, we think there's a lot of money that can be made in a very, risk-tolerant manner. But you can't ignore the fact that the world's a very different place, it's become a very dangerous and uncertain place, and that's just going to be part of the dynamic when you put together a strategy.
And as you know, we talk about that a lot here at Aspen, and I was having lunch with somebody yesterday who's from Nigeria, and they have a Taliban movement in the northeastern part of Nigeria that's starting to cause problems. And I say, when is that going to go away? He said, when the government starts helping and promoting economic growth so people can have jobs. And he said, so if you crush the Taliban movement, something else will occur because people that are totally disadvantaged have very little to lose. And that's, of course, a lot of what's going on in the Middle East. So in the long term, the only solution is obviously to try to get people to where they have a reasonable standard of living. And if that doesn't happen, this is going to go on for an awful long time.
Yeah, that's a great point. I mean, think back to World War II. I mean, same thing, right? You just
That's
it's-
the
yeah,
whole point of what we did in
exactly
Europe,
right.
sure. I think we are out of time, and I apologize for those that we haven't had a chance to answer your question. And I thank you all once again for coming and listening to us talk and participating as well. Thank you.
Thank you.